18 months ago, 94% of Wall Street analysts told you Intel was a sell. And the stock then moved in a way almost none of them predicted. Here is the uncomfortable part. The analysts weren't actually wrong about the business itself. They were wrong about something else entirely. By the time this video ends, you'll know exactly what they missed. And the one number that decides if Intel is a value trap or a real turnaround. Quick intro before we get into it. 7 years on the sell side, covering semiconductors across the US and Greater China gave me my training. And I went independent after that, which means I'm not coming at this cold after modeling this company through 3 CEOs and 2 foundry strategies. Intel just closed another quarter. The foundry spin-out math is finally public. And both TSMC and SMIC have reported within the same window, which lets us put all 3 on a single page for the first time in years. 3 terms will carry most of the weight here. Gross margin is revenue minus the cost of making the chip, divided by revenue. And for semiconductors, anything sitting under 40% counts as a warning light. Free cash flow is the cash left over after the company pays for its factories. And Intel's FCF number happens to be the entire story. A reverse DCF flips the usual exercise on its head, because instead of guessing future growth, we work backward from today's price and ask what growth rate that price actually requires. The plan splits into 3 parts. Part 1 covers where the analyst consensus broke down. Part 2 walks through the real numbers and a reverse DCF on today's price. And Part 3 Steelman's the bear case. We close with a cross-market angle comparing Intel to SMIC in Hong Kong, because that comparison genuinely changes the thesis. The bearish consensus on Intel wasn't built on bad data. It was built on the wrong question. Throughout 2024, the dominant view stayed simple and brutal. Intel's data center revenue had collapsed from $26 billion in 2021 down to under $13 billion by 2024. Gross margins slid from 58% into the high 30s, and capex kept running near $25 billion a year against negative free cash flow. The call was straightforward, which was to avoid the stock. Judged on the operating business alone, that call held up as reasonable. Picture a restaurant chain selling off its best locations to fund a new central kitchen that won't open for 3 years. And that is roughly the situation. Looking only at this quarter's dinner receipts will make you hate the stock. But asking what the kitchen is worth, once it is actually running, might flip you to loving it. What got underweighted was the optionality sitting inside Intel Foundry. Real numbers finally arrived once the foundry segment started reporting separately. And they were ugly. Roughly $13 billion in operating losses on something like $18 billion in internal plus external revenue. Here is the thing though. About 95% of that revenue was still Intel selling to itself, while the external customer book carrying names like Microsoft and the US Department of Defense remained tiny, but was growing off a base near zero. The bear case priced a dying product company, while the bull case required you to value a pre-revenue foundry as a separate entity. 2 different stocks living inside the same ticker. Time for the meat of the analysis, which comes down to 3 numbers and then a valuation. Start with gross margin trajectory. Management guided to a recovery path that climbs back toward the mid-40s, with a longer-term target near 60% as the 18A process node ramps. And recent quarters have printed in the low 40s, which isn't the target but no longer looks like a collapse. Number 2 is capital intensity, which is where the story really shifts. Capex peaked around $25 billion, and then the company guided net capex, meaning capex minus government grants and partner contributions from the CHIPS Act and Apollo, down into the $12 to $14 billion range. That single line item separates a cash-burning company from a self-funding one. The third number is the free cash flow inflection. From a trough of roughly negative $15 billion in free cash flow, Intel has charted a credible path toward break-even. with management targeting positive adjusted FCF as the new node scale. On to the reverse DCF, which is the screenshot moment of this video. Take Intel's current market cap of roughly $140 billion. Plug in a 10% discount rate and a 2.5% terminal growth rate, and you can back out the free cash flow growth that the market is currently pricing in. The answer lands at roughly 3 to 4% annual FCF growth across the next decade off a normalized base. 3 to 4%. Full stop. The market is pricing Intel like a slowly declining utility that happens to carry a chip logo. You don't have to believe Intel becomes TSMC. You don't have to believe 18A turns into a hit. You only have to believe Intel grows free cash flow faster than a regional electric utility. If foundry external revenue moves from near zero up to even $5 billion by 2028 at industry standard foundry margins, the implied growth rate clears with plenty of room to spare. Let me steelman the opposite view, because the bears have real ammunition. Risk 1 is process node execution. Intel has missed roadmap targets for the better part of a decade. And 18A now has to ship on time, at competitive yield and at competitive performance per watt. TSMC SN2 node sits as the benchmark, and TSMC hasn't missed a node transition in years. If 18A slips by even 9 months, the foundry customer pipeline, including Microsoft, Defense, and anyone else signed up, has every right to walk. The second risk is customer concentration on the product side. AMD keeps taking server CPU share quarter after quarter, while the hyperscalers including Amazon, Google, and Microsoft keep designing their own custom silicon and routing the fab work to TSMC. Even in a scenario where Intel Foundry wins, Intel products can keep bleeding. Risk 3 sits inside the capital structure. Intel suspended its dividend, took on real debt to fund the fab build-out, and the CHIPS Act grants arrived with strings attached, including limits on expansion in China. If margins recover slower than guided, dilution or asset sales become live options. The thesis isn't that this is safe. It is that the asymmetry has shifted. And those are two different statements. Here is what most US-focused channels miss. Valuing Intel correctly requires you to look at SMIC in Hong Kong. SMIC trades under ticker O981 in Hong Kong and 688,981 on the Shanghai Star Board. And the multiples on those two exchanges look wildly different. The Hong Kong listing trades around 2 times book value, while the A-share listing trades closer to 5 times book, despite being the same company, same fabs, same wafers. That gap exists because of capital controls, index inclusion rules, and a domestic Chinese investor base willing to pay a strategic premium for sovereign semiconductor capacity. Now flip the lens to Intel. The US government has committed roughly $8 billion in direct CHIPS Act funding to Intel, plus loan guarantees, which is the American equivalent of a sovereign premium. And it simply isn't priced in yet. Intel currently trades at roughly 2 times book value, which sits almost exactly at SMIC's Hong Kong multiple. Despite operating in a market with deeper capital, a stronger customer base, and explicit government backing, if sovereign chip capacity gets re-rated this decade, and the policy direction in Washington, Brussels, Beijing, and Tokyo all points the same way, Intel ends up as the cheapest seat at that table among publicly investable Western foundries. 3 specific things to do this week, none of them vague. First, watch one metric, which is Intel Foundry's external revenue line in the next quarterly report. If that number clears $1 billion in a single quarter, the thesis stays on track. And if it stalls below $500 million for 2 quarters in a row, the thesis is breaking. Second, put a calendar alert on the next Intel Investor Day and the 18A production ramp announcement, both expected in the back half of this year. And don't act before those events. Third, read Intel's most recent 10 and pay attention specifically to the segment reporting section where Intel products and Intel Foundry get broken out separately. 40 minutes of careful reading will outperform 40 hours of YouTube. This video included: quick recap. 1. The consensus sell call was answering the wrong question because it priced the product business and ignored the foundry option. 2. The reverse DCF shows that today's price only requires 3 to 4% FCF growth, which is a low bar rather than a high one. 3. SMIC's 2 listings demonstrate what sovereign premium repricing actually looks like, and Intel currently trades without that premium baked in. Full disclosure on my position: I don't own Intel, I'm not short Intel, and I have no plans to open a position in the next 72 hours. Next week's video runs the same reverse DCF treatment on TSMC at its current multiple, and the answer there lands far less comfortably than most people assume. The analysts weren't wrong about Intel's business. They were wrong about which business the market had already priced. And that distinction between what is priced and what is true is the entire game. See you in the TSMC one.